Hello, Happy New Year, and welcome to my channel, The Quality Investor. On today's video, I want to discuss why Visa, a legacy payment processor, is a superior investment to PayPal, the cool kid fintech payment disruptor. As investors, our primary concern should be how much will our capital investment in a business grow. The type of business, status thereof, newness of tech, or hype surrounding a business is all secondary, even tertiary, to the primary concern. And the best correlation, in my view, of superior returns is how much cash that business delivers to shareholders. Whether we want to believe it or not, cash delivered by a grocery store is exactly equal to cash delivered by a streaming business, which is exactly equal to cash delivered by the latest AI revolutionary. Our concern then should be how much cash is delivered by that business, and will that cash compound over time? If the answer to one is a lot, and the answer to two is it will predictably compound over time, then we will receive above average returns. Cash is, has been, and will always be king. So, before waxing poetic on free cash flow, if you enjoy content like this, please hit that like button and subscribe to the channel. Also, hit that notification bell so you can know right away when I post more stock analysis content. The best proxy for that deliverance of cash is free cash flow. I am a huge proponent of free cash flow on this channel, and it is one of my base metrics for any investment I want to make. If a business has below par, erratic, or declining free cash flows, I immediately put it in my discard pile. That is not to say the investment will always remain in that pile, but it is to say I must see hard evidence over multiple quarters and years that free cash flow is growing and will predictably continue to grow for me to consider that investment again. I see many comparisons in the investment space of Visa and PayPal, and it typically follows the line of reasoning that PayPal's revenue is roughly as much as Visa's and growing roughly at the same rate. Therefore, the market is severely undervaluing PayPal, even though PayPal is about the stature of a business as Visa. I want to dispel these notions that PayPal is even in the same league as Visa, and that it is valued exactly as it should be. That said, PayPal can certainly rise to the stature of Visa, but it has work to do and must show consistent improvements in its operations over many quarters for me to consider it as a quality investment. Visa and PayPal are fundamentally different business models, however. Mainly, Visa is a card network connecting consumers, merchants, and banks. Visa facilitates the flow of money throughout the payment process and collects a fee on that transaction. If the card network is a highway, the fee is a toll. PayPal can act in this more traditional role, though it primarily is an e-commerce payment solution. It provides end-to-end encryption of the payments without consumers sending billing info to merchants, and also does peer-to-peer money transfers. It is also a closed-loop system, meaning consumers and merchants must join in order to interact with one another. PayPal's real potential comes from acting as an e-wallet and users transacting within its own ecosystem, thereby cutting out Visa and MasterCard from collecting a transaction fee. This is a simplified explanation, however. They are similar in that they process payments. PayPal is doing the right things in terms of increasing transaction volume, which increases the transaction fees and thus revenue. But an investment is so much more than top-line growth, and that is where the similarities between PayPal and Visa end. It's what happens from the revenue part to the free cash flow part, where Visa proves to be a vastly superior business and thus a vastly superior investment. At least for now. I am not arguing that PayPal is a bad business. I am arguing that PayPal is a bad investment. So let's take a quick look at those returns. And I also put MasterCard on this list here between Visa, PayPal, and MasterCard. So looking at the 3, 5, and 10-year returns plus year to date, we can see that Visa has returned 26.3% in 2023, 23.4% for MasterCard, and then PayPal has lost 13.8% in 2023. And then on a 3-year basis, PayPal has a pretty staggering annualized loss here of 35.7%, where Visa and MasterCard have both returned around 7.5%. And on a 5 and 10-year basis, Visa and MasterCard have both outperformed the S&P 500 pretty well. Visa at 15.5% on a 5-year and 17.7% on the 10-year, whereas MasterCard's even better at 18.7% on a 5-year and 18.5% on the 10-year. PayPal's IPO was in 2015, and you can see that since that IPO, they have not returned very well for investors. Their 5-year annualized return is at -6%. So, despite growing its top line in line with Visa and MasterCard, PayPal is still underperforming vastly, not only the market as a whole, but is lagging far behind Visa and MasterCard in the payment processing space. So let's dig a little bit into those numbers to see why that is the case. All right, looking at some compound annual growth rates here for various metrics, we can see on a revenue per share basis, PayPal has actually done a pretty good job of beating Visa on both a 5 and 10-year compound annual growth rate. PayPal has grown their revenue per share over 17% in those 5 and 10-year periods, whereas Visa is not even hitting 14% on the 5 and 10 years. However, the growth has slowed a little bit for PayPal on a 1 and 3-year basis, whereas it has accelerated a little bit for Visa on a 1 and 3-year basis. However, the story becomes a little bit clearer when we look at gross and operating margins and how they've expanded or contracted on these 1, 3, 5, and 10-year periods. For Visa, it's remained pretty flat in their margins for the last 1, 3, and 5, and 10 years, whereas you're seeing pretty significant contraction of gross and operating margin for PayPal. Just on a 1-year basis, their gross margin contracted by 9.27% and operating margin by 13.7%. You do not want to see contracting margins. That really shows costs are not under control when that is the case. Worst case, that could be the business is declining. And looking at earnings per share, again, you can see pretty steady, consistent growth for Visa, whereas for PayPal, there is growth over the last 10 years, but it's also erratic growth. There's periods of fast growth, and then it slows down, and then last year they lost 40% in earnings per share. And then, of course, the king metric, free cash flow. All right, so free cash flow per share, you can see over the last 10 years, Visa has increased that by 25.5%, and it's been nice growth for PayPal over the last 10 years and over the last 1, 3, 5-year periods as well. But the margins tell a very different story. Over the 10 years, Visa has expanded their free cash flow margin by 10.7% per year, whereas Visa has slowly been contracting their free cash flow margin over the last 10 years. And then even last year, their free cash flow margin declined by 3.7%. So that's not just the whole story here. How is management allocating capital for these two businesses? All right, we're looking at return on invested capital for PayPal and Visa. PayPal's in red, and you can see that PayPal's just not done a great job of increasing their ROIC. They're at 8% in their last fiscal year, whereas Visa is at nearly 30%. And not only that, you can see it's just a clear upward trend on ROIC. So Visa's management has done a better job allocating resources than PayPal's management. So for me, when I look at these charts, this is where the picture becomes crystal clear for why PayPal is simply not performing as what investors have been wanting it to perform since its IPO. You can see that revenue increase has been fairly consistent for PayPal and Visa. And you can see that PayPal almost has as much revenue as Visa does, $27.5 billion in the last fiscal year versus Visa's $32.6 billion. But after that, it kind of gets off the rails for PayPal a little bit. Looking at the SG&A, you can see that PayPal has just not done a good job of controlling their costs. So Visa has significantly more revenue, about $5 billion more revenue than PayPal, yet their SG&A in the last fiscal year is $3.2 billion versus PayPal's of $4.3 billion. That's not good. And so how is PayPal allowing their costs to increase so much on even less revenue than what Visa is doing? And earnings per share, even worse. You can see it's slight decline the last 3 years for PayPal and earnings per share, where Visa's just consistently grown over time. Visa's doing $8.28 versus PayPal's $2.09 on an earnings per share basis. Before getting into the cash flow components here, CapEx and free cash flow stuff, let's look at these margins. So up here, you can see the gross margins. What I was talking about earlier, Visa was relatively flat over the last 10 years or so, but not only are they flat, PayPal's declining at a pretty significant rate here, and PayPal's margin itself is far lower than Visa's gross margin. PayPal's at 50% gross margin versus Visa's at nearly 80% of a gross margin. On an operating basis, again, they're both pretty flat. However, Visa's doing a much better job of controlling overhead overall, thus having a much higher operating margin. Visa's operating margin in the last fiscal year is at 67% versus just under 15% for PayPal. And this SG&A percent of gross profit chart, I think, illustrates that very well. You can see here that PayPal has very slight increase over time of their SG&A as a percentage of gross profit. So the last fiscal year, PayPal has spent 31 cents of every dollar of gross profit on SG&A, whereas Visa has spent 12 cents of every dollar of gross profit on SG&A. Visa's demonstrating they're far better at managing their overhead and dealing with costs. To me, this shows that Visa is a leaner, more efficient business than PayPal, at least right now. Now let's come over here and we'll take a quick look at CapEx. All right, so Visa is actually spending more money in CapEx than what PayPal is doing. So Visa did about $1 billion in their last fiscal year versus PayPal's last fiscal year of $700 million in CapEx. But come down to this chart over here, CapEx as a percent of net income. And you can see that PayPal over time has paid a far larger share of their capital expenditures as a percentage of net income than Visa has. As of the last fiscal year, PayPal has paid 29% of their net income towards CapEx, whereas Visa has only paid 6% of their net income towards CapEx. This is telling me that proportionally, Visa has to spend far less of their net income in order to maintain their position and their operations in the market. Now that said, a lot of these investments that PayPal is making will pay off in the future, but before considering PayPal as a good quality business, I want to see some return on that investment. And finally, we have these three charts here in the middle: free cash flow per share, stock-based comp per share, and free cash flow per share adjusted. Let's look at each one of these individually. Starting with free cash flow per share, you can see Visa has done a very good job of just consistently growing over the last 10 years their free cash flow per share. The last fiscal year, they're at $9.45 per share for free cash flow, whereas PayPal, on the other hand, has fairly much stagnated over the last 5 years or so. Last year, they did $4.41 free cash flow per share. So from a purely investor perspective here, not only is PayPal doing less than half of what Visa is doing on a per share basis for free cash flow, they're not even growing it over time. So you're not getting more over time out of your investment in PayPal. So let's talk about stock-based comp per share here. You can see PayPal has a far higher per share stock-based comp than what Visa's doing. Now, stock-based compensation is not a cash expense. However, it does have a dilutive effect on shares outstanding, and you can see how that might hurt our free cash flow per share once you account for stock-based compensation in free cash flow. So as in last fiscal year, as a comparison here, Visa did about a third of what PayPal did, 37 cents per share versus $1.09 per share for stock-based compensation. So what does that actually mean? A quote here from Aswath Damodaran: the stock-based compensation may not represent cash, but it is so only because the company has used a barter system to evade the cash flow effect. Put differently, if the company had issued the options and restricted stock that it was planning to give to employees to the market and then used the cash proceeds to pay employees, we would have treated it as a cash expense. So what is he telling us here? Well, it's no doubt correct that stock-based compensation is not a cash expense. That is only because companies have found a way around the effect. If a company were to do a capital raise and use the proceeds from it to pay employees, we would treat that as a cash expense. So what does that mean for free cash flow? So when we're looking at our free cash flow per share adjusted chart, what I'm doing here is I'm backing out that stock-based per share from the free cash flow per share. That leaves us then with $9.08 for Visa in their last fiscal year, whereas PayPal now goes down to $3.32 on a free cash flow per share adjusted basis. So for PayPal, that's a staggering 24.7% dilution of free cash flow when you account for that. So they had $4.41 before accounting for stock-based comp and $3.32 now, whereas Visa's dilution was only 3.9%. So as of right now, PayPal is simply not being run in a way that's truly beneficial for shareholders, and thus that's hurting returns, whereas Visa is very much run in a way to benefit shareholders. So what does that look like on a stock chart? Well, PayPal's IPO was July of 2015, and using that as a starting point, you can see here the blue is the share price and the green is the free cash flow trailing 12 over that time, and both charts show a stark correlation between free cash flow and share price. Visa's share price has steadily risen over time as free cash flow has steadily risen. And PayPal, well, it's much the same. PayPal's free cash flow has not risen the way Visa's has, and their share price is a reflection of that. And you see here that once that free cash flow for PayPal did start to increase a little bit over 2020, there was a commensurate increase in share price, probably based on a bit of hype. But as soon as that free cash flow started to stagnate and now it's declining, you're getting that same decline in share price for PayPal. My contention as an investor is that higher free cash flow is the long-term driver of investment returns. Any business that shows free cash flow growth and predictable compounding is at the very least worth consideration. Cash flow, cash flow, cash flow. The more cash a business delivers to its investors, the more its multiple expands and the share price increases. Visa generates more cash in the pocket for the investor. And until PayPal can demonstrate in a real and tangible way that it can deliver the same level of cash to the investor, PayPal will remain at an inferior market cap than Visa. Before we go, I do want to remind you this is not financial advice. With that, thank you for watching today's video. And what are your thoughts on free cash flow? Let me know in the comments below. Finally, please hit that like button. And if you found this info helpful, consider subscribing to the channel. Thank you and happy investing.